Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews where we talk to someone about some interesting ideas in economics and business. And today we're here with DSGeoffBertram, who is from the Institute of Policy Studies, an economist who spoke this week to the Fabian's Institute Productive Economy seminar here in Wellington. And Jeff, you made some interesting comments about what's happened to inflation in New Zealand over the long period and the difference between tradable inflation, the stuff that exporters and those who compete with importers have to deal with, and non-tradable inflation, and how since the mid-80s there's been quite a divergence between tradable inflation and non-tradable inflation, which has sent some signals into the economy. Can you say what's happened there in terms of that divergence?
Okay, well, what's happened is that, particularly since the Reserve Bank began targeting inflation using the interest rate, the method that we use in New Zealand to control inflation selectively squeezes tradable producers and puts less of a squeeze on non-tradables. The reason is simply that when you raise the interest rate in New Zealand, it drives the nominal exchange rate up. That reduces the profits of the tradable goods sector. It leaves the non-traded sector pretty much untouched. The result of that is that over the last 30 years, non-tradable inflation has consistently run ahead of tradable inflation, and the logic that follows from that is that there's a relative price shift in favour of non-tradables against tradables.
So the Reserve Bank's inflation targeting regime has in effect favoured the non-tradable part of the economy and in a way punished the tradable part of the economy.
Yes, that's right, and it's an inevitable consequence of choosing to do interest rate inflation targeting in an open economy with no capital controls. So the whole package just ends up as a relative price squeeze against tradables. And what the numbers show is that until the float of the New Zealand dollar over the previous 70 or 80 years, the relationship between tradable and non-tradable prices fluctuated but stayed pretty much along a level path. Once the dollar was floated, there's a sharp change, and from there on until the present, the non-tradable price relative to the tradable price goes up steadily. Now that's an inexorable secular squeeze on the profits of the tradable sector. That's a price signal in the economy for resources to move out of tradables into non-tradables, for investment to focus on non-tradables, not tradables, and down the track that ends you up with an economy unable to produce enough exports to pay its way.
Now, how do we change this? What sort of options are there to try and turn that around?
Most fundamentally, we need to either change the inflation targeting regime itself or add other bits to it to try to make sure that there's a restraint on non-tradable inflation that is as effective as any restraint on tradables. Now, I'm not a great fan for the current interest rate OCR-based approach to controlling inflation, but if you're going to stick with that, you do need to have something added to it to deal with, firstly, the tendency of the nominal exchange rate to be too high, and secondly, to deal with the tendency of non-traded goods prices to roar away without restraint. Now, the first of those, I think, is a job for the Reserve Bank, and it requires regulation of the bank's balance sheets to try to force them to stop using foreign currency denominated loans to fund New Zealand dollar denominated lending. So I argue for reducing the currency mismatch in the bank's balance sheets by a regulatory instrument that would ratchet down over time the ratio of allowed foreign currency. The other thing, the restraint on non-tradables is a directly regulatory issue outside monetary policy. And I think it requires direct intervention in things such as the housing market, which is a matter partly of changing the tax regime, in the production of utility services such as electricity, gas, ports, airports, telecommunications. That requires a better regulatory regime to control the run-up of asset values and costs in those sectors. So I think there's quite a number of pieces need to be added to the policy regime right now.
Now, one aspect you focused on in your presentation was this currency mismatch, where after 1993, our banks borrowed offshore, and a lot of it in non-New Zealand dollars, to the point where much of their funding now is in non-New Zealand dollars, and there's a risk there that if the New Zealand dollar slumps, then that could really hit those banks. How do we reduce that vulnerability?
Well, that's a matter of getting their assets and liabilities denominated in the same currency. At the moment, they owe a lot in foreign currency offshore. They have a lot of assets in New Zealand that are repayable in New Zealand dollars. That means that there's a big exchange rate risk. They can hedge that in the short run, but in the longer run, the exchange rate risk lies on the bank shareholders. It gives them a vested interest in keeping the New Zealand dollar high. And insofar as they keep on pouring foreign currency into New Zealand to fund their lending here, that contributes to keeping the dollar high. So we need to stop the inflow of foreign currency to fund domestic credit creation. We need to unwind the mismatch in the balance sheets, which is currently about $80 billion. Where the banks, that is to say, have $80 billion of New Zealand lending that's backed by foreign currency liabilities. And I think that's a matter of regulating balance sheets, and that comes down, I think, to giving the Reserve Bank a mandate to get on with that.
Now, one of the things you talked about were currency bonanzas, where an economy receives a shock, if you like, of inflows of foreign currency. And it's been talked about as the Dutch disease in overseas countries, after the Dutch saw a inflow of foreign currency when they discovered gas in the North Sea. Now, one solution some countries have come up with is some form of stabilisation fund to park that money so that it doesn't surge into your economy, push up your currency, destroy your manufacturing sector and create inflation. What do you think of the idea of some sort of stabilisation fund?
Well, I think it's fundamentally sensible to have one. I think it's an important part of monetary policy for small open economies that you have a mechanism to deal with windfalls when they hit you. All around the world at the moment there are peripheral countries which are finding American dollar holders trying to invest out of the United States, and as a result exchange rates are being driven up, and there's pressure for overseas investors to get more and more toeholds in peripheral economies by buying assets. And a lot of countries around the world are now worrying about this bonanza hitting their economies and forcing their exchange rates out of line, and thereby shifting their economic structure away from a sustainable basis. Now, the oil economies, particularly Norway, have indeed pioneered this practice of parking the money. The Chinese have been parking enormous amounts of American dollar assets as they run a large trade surplus with the United States, and there's quite a lot of aspects to that, but the idea is definitely there of running a fund where you park the foreign exchange that's coming in. New Zealand's facing a bonanza with the Christchurch earthquake reinsurance. We have somewhere between 6 and 10 billion coming, I think, in the next year or two from offshore insurance companies to pay for rebuilding Christchurch. Now, rebuilding Christchurch doesn't need a lot of foreign currency. It's local resources that will be needed. They can be purchased with New Zealand dollars. We don't actually need a flood of extra foreign currency hitting the foreign exchange market. So that's a place where I would start by looking at possibly sterilising it and putting the foreign currency aside somewhere.
Geoff Bertram, an economist from the Institute of Policy Studies, here in Parliament after the Productive Economy seminar. I'm Bernard Hickey. That was another in our double shot interview series for interest.co.nz.